Welcome back to the channel. My name is Gordon Frayne, and today we're discussing the top crypto trading strategies that you need to know about when joining the crypto space. As always, if you enjoy the content, please make sure to smash that thumbs up button. Hit the subscribe button as well. We're on the road to our first 10,000 subscribers, and it would mean the world if you subscribed. And hit that bell notification icon so you can get notified every time we drop a new video. I've also got a free copy of my book, The Rise of Bitcoin, for you in the description below. Click the first link in the description. You'll get a full free PDF copy of the book. It's my gift to you. It will not be free forever, so make sure to grab it now while you can. So, this video, we're going to be jumping in and talking about the key different trading strategies when it comes to the Bitcoin and crypto space. And this video will be more helpful for beginners, but it might be beneficial for you as well. So when you enter the crypto space in general, you might hear a lot of people talking about these two different investment strategies, and they will be dollar cost averaging and the hold on for dear life or HODL strategies. Dollar cost averaging is not unique to cryptocurrency. It's a strategy that has been in operation for decades with people investing in the traditional stock market as well. But essentially, it is the practice of systematically investing equal amounts of money at regular intervals, regardless of the price of an asset, and by spreading out the total amount to be invested across periodic purchases, investors can potentially lower the average cost basis. HODL, or hodling, on the other hand, is a misspelling of the word hold on for dear life. It refers to holding on to cryptocurrencies rather than selling them. Even in the face of extreme price fluctuations, the HODL strategy is based on the belief that despite volatility, the value of crypto will be higher in the long run. So if you're getting into crypto and you're getting involved in this space in general, and you're a believer in the technology and the underlying infrastructure that's being built out for this new world, then you don't really have a huge amount to worry about, and you might just want to invest your money and hold it for the long term, not worry about trying to get in and out of trades, not worrying about trying to squeeze every dollar out of the market. If you fundamentally believe, understand, and really invest in the technology, then you're happy to hold for the long run, and those price fluctuations don't matter all that much to you. But the dollar cost averaging strategy might be the next best option, because with a DCA strategy, basically what you're doing is you're averaging out your cost basis over time, and you're deciding that, okay, once per month, I'm going to invest $1,000 into Bitcoin every single month, no matter what the price is. And over a long enough time horizon, that means that you're not jumping in with huge chunks of capital when the price goes way up and you're chasing the price, but you're also investing at regular intervals to get the benefit of the price when it dips, and you're averaging out or potentially lowering your cost basis over time. So rather than doing a lump sum, which is the example in this right diagram here, when the price is, let's say, just above $40,000, you buy a huge amount of Bitcoin, but then you don't buy for the next few months as the price continues to dip. On the other hand, if you employ a dollar cost averaging strategy, you would buy a small amount at 40K, another amount here in May at 40K. Then when we dip to 30K in June, you still buy another small amount. Again, when we dip to 20K in July, you still buy a small amount. And then again, when we consolidate in August, you continue to buy a small amount. So rather than investing, let's say, $50,000 in one lump sum at $40,000, you might decide to invest $10,000 per month at each of these intervals. And if you had done so, you would have lowered your cost basis over time, because you would have bought 10,000 at 40K, another 10,000 at 40K, but then another 10,000 worth of Bitcoin at 30K, another 10,000 and another 10,000 at 20K, therefore lowering your overall cost basis. So this is the crux of the DCA, or the dollar cost averaging strategy, and most investors would tell you, or would advise, again, this is not financial advice, but most investors will advise that a DCA strategy is a very healthy strategy for building a long-term bag of a particular asset. And again, it does not just apply to Bitcoin, but many people in the Bitcoin and crypto space will typically employ some form of DCA strategy and consistently decide to invest X amount of dollars every single week or every single month over a long-term time horizon. This means you do not have to guess or try to time the market. You don't have to try to think, okay, is Bitcoin going to be less next month or higher next month? You make the decision and you employ discipline to execute that decision-making process on a very consistent basis over time. And we're going to look at a quick example of what this might look like and how those returns can compound over time, because when we think about the actual compounded annual growth rate of Bitcoin over the past 10 years, we have seen that an investment of about $1 since April 2014 would now be worth $148.28, which is a total return of over 14,700%, which equals about a 64.86% annualized return on Bitcoin over the past 10 years. So let's run a quick experiment to think about what that looks like over the course of the next 20 years if we extrapolate out those compounded annual growth rate returns and what your investment in Bitcoin might look like at the end of those 20 years. So again, hypothetical example here, but it's just to show you the power of a dollar cost averaging strategy and a compounded interest with that CAGR over time. So if you started off with an initial investment of about $10,000 and you decided that each month you're going to contribute $1,000 into Bitcoin and dollar cost average in $1,000 every single month for the next 20 years, what we've plugged in here as the estimated interest rate or the estimated return rate is only 30%. Remember, Bitcoin's compounded annual growth rate has returned over 64.86% for the last 10 years annualized. So we've just cut this number in half to keep things very conservative here. We're saying less than half of this at a 30% estimated interest rate compounded annually. That would give us, if we calculate it, a return on investment or a total investment portfolio worth $9.46 million after 20 years. Again, we can really see the power of the compounding effect here with that compounded annual growth rate, especially when we get to year 12 and beyond. It really starts to go exponential here. But again, this example is just to show you the power of how you could start off with just $10,000 and decide that you're going to employ a dollar cost averaging strategy and invest an additional $1,000 every single month for the next 20 years. You would have $9.4 million after that 20-year time period. Again, you might have a lot more capital to deploy. Let's say we started off with $20,000 and you had about $1,800 of a contribution every single month with the same estimated return rate compounded annually. That would give you upwards or pretty much just $14 million after 20 years. So you have the choice to plug in these different variables and think about how your investment can compound over time with a dollar cost averaging strategy. But, you have to take the discipline and you have to be able to sit down and put the money into that investment in a very, very strategic and disciplined way. Luckily, there is a number of features on various exchanges that allow you to... I'm just going to open up the Jupiter exchange here. On Solana, it is a decentralized exchange. And for example, they have a DCA option here with the exchange itself. So most of the cryptocurrency exchanges are now adding this feature that basically allows you to set up an automated dollar cost averaging strategy where you can decide, okay, I want to allocate, let's say, as per our example, $1,000. Again, this example is Solana, but let's take maybe, I don't even know if they have Bitcoin on Jupiter. They don't even have a wrapped version of Bitcoin, perhaps. They do, wrap BTC. So this would be your option for DCAing into wrap BTC. or Sol's version, a wrapped version of BTC. And you could say, I want to purchase $1,000 worth of BTC every month over X amount of orders. So if you wanted to do that, let's say, and set it up for the next 2 years, you would put in 24 months or 24 orders because you're doing it once per month. And then you simply connect your wallet, make sure you have the funds in your wallet, and then it will execute that dollar cost averaging strategy every month for the next 24 months. So very powerful, the way that we're now seeing these technologies and these decentralized exchanges now facilitating the ability for you to dollar cost average into these various different positions. So dollar cost averaging and HODL are probably the two fundamental different investment strategies when it comes to the crypto space, but you may also be wanting to get into the trading of Bitcoin and crypto on a more frequent basis. And there's basically 3 different strategies here that you can employ depending on, I would say, both your risk appetite and how long you want to be sitting in and out of positions. So the first strategy here is called scalping, which is basically trading Bitcoin and crypto on very, very short time frames. So you might be using the 1 minute or 5 minute charts on TradingView or your DEX or centralized exchange of choice to get in and out of positions in very, very short time periods. So this means doing hundreds of trades daily, relying on high frequency trading and quick decisions, requiring high performance technology and fast internet. It does have higher transaction costs due to the frequency of trades that you're doing, and it is intensive and time consuming. However, you will have seen on a lot of different platforms now, you can do AI trading bots and use bots for executing trades on your behalf. And a lot of these trading bots do employ a scalping type of strategy where they're getting in and out of positions on very, very low timeframes. So scalping is for people who want to be getting in and out of very high frequency trades on very small timeframes. Day trading, again, you might know of day trading from traditional investing, but day trading does also focus on short time term trends or short time frames with trades lasting a few hours at a time. So normally scalping, you might only be in a trade for a few minutes. Day trading, you can often be in trades for up to a few hours, yields higher profits per trade than scalping typically. It does require strong risk management and discipline. It is time consuming and aligns with market activity peaks, and there is a high probability of losses due to market volatility. That is especially true in the crypto space. But if you're someone who wants to be making a living from trading Bitcoin and cryptocurrencies, and you're doing that day in and day out, then executing a day trading strategy might be the best for you. However, option number 3 or strategy number 3 here is the swing trading strategy. And swing trading utilizes more of a medium to long-term market swing trade strategy that oftentimes lasts days or weeks, though this is typically less risk averse due to fewer trades and wider stop loss margins. It does require more patience and ability to withstand stress. It is flexible in terms of time commitment with analysis outside market hours, and exposure to overnight market fluctuations is a primary risk. Not as much the case in the crypto market in general because it's 24/7. However, swing trading might suit your personality better if you're not someone who wants to be staring at the computer screen for every minute of every day, as would be more so the case with day trading and scalping. Your swing trading is going to allow you to enter trades and stay in those trades for multiple days, if not multiple weeks, sometimes even months before you would think about exiting a particular trade after a return on investment. You would be using much higher time frames like the daily chart or potentially the weekly chart even to determine how you get in and out of those positions and how long you will stay in them. So swing trading is a slightly more hands-off approach. Of course, it does require a lot of discipline and research as well, but you're not going to be getting in and out of positions every single day if you're executing a swing trading strategy. So at a very high level, they are the different trading strategies that you need to know about when you're getting involved with Bitcoin and crypto. And as I said, the dollar cost averaging and hodl strategies are kind of like the two fundamental pillars if you are someone investing in crypto and you genuinely believe in the technology and the underlying infrastructure, and you're someone who believes we're going to be using Bitcoin, crypto, and blockchain technology for the next decade and beyond. Whereas these three strategies remove the kind of romanticism behind the ideas of Bitcoin and blockchain, and would be more focused on you getting in and out of trades by reading the charts, understanding the data, and removing emotion from your trading decision making. So again, all of these strategies are good to know at a high level. The whole point of this video was to introduce you to all of these different strategies. If you want different videos on any of these strategies in particular, please let me know in the comment section below so we can put together more informative videos for you and do a deeper dive into any of those respective strategies. As always, if you enjoy the content, please make sure to smash that thumbs up button on your way out the door. Hit that subscribe button as well. We're on the road to our first 10,000 subscribers, and hit that bell notification icon so you can get notified as well. Make sure to grab your free copy of The Rise of Bitcoin on your way out the door. It's the first link in the description below. Grab it while it's free. It won't be free forever. As I said, it is my gift to you, so get it while you can. And as always, we'll catch you in the next one.